Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, we got PPI today, but we got a few minutes, so let's come over here to the charts, try and go through it really quick here. The 10-year is a little bit lower after that jobs revisions number yesterday. They sold. I do not see or have been unable to locate any good reason for why they sold off of that, because I think that is objectively dovish. But it could be that some people were taking profits on their dovish bets ahead of this PPI, which could be hawkish, right? S&P 500 quite a bit higher this morning. We're right back up at all-time highs. Oil looking a little bit better today as well. There's gold and silver still forming pretty well. Copper, middle of the road, still in a range. Japanese yen coming off of some of the big moves that we had yesterday. Bitcoin still just kind of trucking along, not doing a whole lot. So, wholly on time, Batman. I know. Well, I've been doing a little bit better. I would have been on time yesterday if it hadn't been for the whole freaking laundry room fiasco. Anyways, that was a really. I tell you what, man. Yesterday when I go to get in the laundry, because I keep my shirts in the laundry room so that they don't absorb the moisture from the shower and get wrinkled. So when I went to open that door, I tell you what, like it'd been a long time since I had like my brain like crashed on something like that. Like, this makes no sense. How could there possibly be something blocking the door? Don't understand. Yeah, that was a funny one. Plus, I tried to get ready because it's PPI here, man. This is a big deal. This is a big deal. Okay, so here we go. And they are higher. PPI. Oh, what the fuck? US PPI month over month negative spot 1 versus an expectation of spot 3. Core PPI negative spot 1 versus an expectation of spot 3. This is it. Wow. If they come back through that, I'd just take more. I think that number, man. I want to say something like super big here, because that number really encourages me. But I always got to pull it back a little bit. I got to remember I'm on the internet and everything. But I'm kind of thinking, well, I can buy just about anywhere, and if it comes back, I can just buy more. So the whole thing here has been we're seeing more unemployment, but we're also seeing inflation above target. PPI is particularly important because last month we saw PPI at spot 8, even though CPI was in line at the spot 3. So how could it be that all of the estimates were at spot 3, but it actually came out to be spot 8? Well, there were certain categories that were particularly high, and it looks like that companies are experiencing increased costs because of tariffs, and you're not seeing it in CPI because the economy is so crap that they can't pass it on to consumers. Consumers don't have the income, so if they increase the prices, they just lose more money. Hence, the prices don't change. But PPI was the place where you were seeing the inflation. So the big question coming in today was, are we going to see another surprise like that? How could it possibly be spot 3 again? But instead, we got a negative spot 1. We actually got deflation on the producer side of the equation today. So assuming that CPI is closer to in line with expectations, which I think is highly likely, this very much clears the room for the interest rate cuts. But not just interest rate cuts, but I think it opens the door for a 50 basis point cut. And so it doesn't really seem like it's giving us much hints in terms of the profile where it's going to sit and base out. But I think that this goes higher. And I think anything below 16 is okay. All right, try practicing playing the range. Let's see. Okay, so they gave a bunch back there, but it was all on like 300 contracts each tick, so. I'm a little, so a couple of things I got to remember here is one, I think that the 5-year is probably going to be more influential in this instance, right? Also, I don't know where we're at in terms of like, the expected volatility and whatnot, or implied volatility. But I can't imagine that the line is at 16, so. Especially since 16 is kind of the place where I think we've had the first standard deviation was actually 14. No way. Really? I find that so hard to believe because yesterday was at 24, wasn't it? I can't remember. But then like we haven't come down that far, and you would expect the implied volatility to be higher today because of the PPI. Well, I don't know. Okay, yes, 20 cents, right? Yeah. I guess maybe the difference between those could be how much lower we are today. I don't know. I was thinking about it yesterday. That they got back to me on like their data, and they don't really offer it to individuals anymore. But they do have an Excel spreadsheet and or an Excel plugin, and the plugin is like way too much per month, in my opinion. But we could web scrape it. Both 2 and 5 have blown out their expected ranges, but both caught the first standard deviation on the downside to the tick. Oh, that's interesting. Well, and that's what I was kind of trying to get at yesterday was, okay, so if we're talking about options, like what is the expected range or the implied volatility for that day? then that is something where if you traded it as a mean reversion, you're going to win most of the time, right? In other words, theoretically speaking, and I really wish that we had a good way of testing this, but since we don't have historical data of that measure, we can't. But I would expect that if you were to do a back test and just every time that we hit first standard deviation up or down, we would just trade, a reversal there. And I would expect that you would win and then hold it for an hour, let's say. I would expect that that would come out profitable, slightly. That you would win most of the time, right? But it's going to have a fat tail, right? And so the point that I'm trying to make is, when are you going to see the fat tail? It's going to be on days where you have certain big news events that are just going to completely blow out those ranges. Or that there's a big buyer out there and that the amount that they're going to buy is going to push it beyond that range, And so with that in mind, this is a situation where I would think that they're more likely to reach those ranges, right? But it's not going to be like all at once. In fact, I kind of feel, actually I'm not, for some reason I don't have my charts set up correctly over here. There we go. The amount that the 10-year moved in terms of contracts is suspiciously low. Very suspiciously low. And there's way more buying in the 30-year. Now, one thing, we haven't really gone through like a reading of the flows, but of course we got PPI, and I think that the PPI is a dovish flow. I don't think that the CPI tomorrow really holds too much back, but there has been some political instability overnight as well, with Poland saying that they need to invoke Article 4 of NATO because their airspace is being violated by Russian drones making strikes on Ukraine. This is something that's kind of been ongoing for a while, but this is the first time that Poland has like come up and like made a big fuss about it like that. So when I was reading my news squawk, they were saying, well, PPI is on deck, but maybe the political instability matters more. And I was kind of like, I don't see how that could be the case. Because I kind of think this Poland thing is something, well, like I'm surprised that there was as much of a reaction to it overnight as there appears to have been, because it kind of sounds like one of those things where like, yeah, it's bad, but then like nothing happens and everybody forgets about it, If the 30 is going to keep going up, you think that the standard deviation is 23. Yeah. So, I talked about this a little bit yesterday, but I mean, maybe what you should do is just post them in the $3 Discord. Just post the levels in the $3. Like I could automate it too, but we could just post them, because I think the whole thing is we want to be like post reports there, and then yeah. Oh well, if you're not paying the $3, I thought you were already in there. I'm pretty sure I already added you on there. Understand that the $3 part is primarily like a firewall to keep robots out. So for you guys that have been here for a while, I know who you are. I'll just let you in. You join the Discord, but don't pay, and then you give me your username and I'll add you. And I've done that for a number of people, I think. Anyways. I really wish there was a better option for chat like that. But it you know, like you see the same thing on Twitter, right? This is Elon Musk's solution on Twitter too, was you have to pay to make an account. Now all of a sudden making 1,000 robots costs $1,000. Yada yada yada. Did it work? I don't know. But also, I need to remember to post my Bitcoin chart tonight, because it would be interesting to see where that is at now. I haven't looked in a few weeks. Still being dragged down in the weeds a little bit too much here. The big thing I'm seeing in the market right now is there has not been nearly as much volume off of this PPI as I thought that there would be. I think that this PPI is a really, like, everything about it, the particular, okay, it's a week before the Federal Reserve meeting. Last PPI was like a really big deal, so you would expect this one to be a really big deal. It's really, really relevant to the decision that the Federal Reserve is going to make, both tomorrow and in the next meetings. So I would expect it to be a really big deal, and it's not doing it. About a single share of IBIT, that means big. I don't even remember what that is. but I tell you what, the Bitcoin world has been really weird, because they have pushed up into new highs. Bitcoin is doing pretty well. I wouldn't say that it's like amazing, like 10x your gains like sometimes in the past, but it's still like more than most other markets they've made. And nobody cares. Nobody cares. I think that's a little weird, don't you? Like, I definitely see this thing where, like, interest has waned in Bitcoin, but, like, there's still waves of interest in things. But no, now it's just like, it keeps going higher and everybody yawns. Now it's like really, really extreme. Got a good little boost there, and there was a little bit of a jump in cumulative delta. Oh, you know what? We did not turn on our algo. We should have that on. I would like to see in this situation where it might see an imbalance. Oh, so you know what? Another thing, because yesterday I kind of like got distracted and forgot about the big 8 o'clock number. Whoa. Okay. Interesting. It was a buy and then an immediate pushback on that, on the DOM. I was curious that it did that right here. That again, you know, that's like the second time now I've seen something where I feel like my algorithm is being messed with. Say the second standard deviation on Xen is 20. Okay. My thinking here, Uzi, is like this is supposed to be like a team effort, so I am not going to worry about it and trust that you will be there to tell me when you think that it's really important. Oh, another thing I should mention. My thinking is I'm not going to worry about where the standard deviation based on implied volatility is, and trust that you will point it out to me if it's particularly relevant. I'll zip up. Okay. So something I do need to talk about is the Lisa Cook thing, because another thing that happened last night was the appeals court said that they did not have the authority to fire Lisa Cook. And it's going to go to the Supreme Court, of course, right? So I think that there's a little bit of analysis that we need to do on it. I do kind of feel like that given the jobs numbers and everything else, that we know where the Federal Reserve is going, and whether Lisa Cook gets fired or not doesn't really matter much. But it's still something that when the Supreme Court rules on it, the market's going to react to it. They absolutely are. Okay. So what is likely to happen? Well, first of all, there's this sentiment, like one of the things that kind of bothers me is when I look at the online discussion on something and the most common talking points don't really help you predict what's going to happen, right? So the most common talking point that I see on the pro Cook side is that they shouldn't be able to fire Lisa Cook based on just some random guy's allegation, right? And I don't think that is a very good argument for predicting what is going to happen. Here's the deal. The allegation is something that's pretty simple to prove. The whole thing is she committed mortgage fraud. She said that she was going to be living in both properties, and she didn't. You can't have two primary residences at the same time. So all you got to do is find the documents for both of those properties, and if she's listing them both as her primary residence, then she's guilty. Pretty simple, right? The Supreme Court, I would expect the Supreme Court to subpoena those records or something, right? So if she didn't do it, they'll call up those records, see that she didn't do it. The allegation is false. The firing is not justified. End of story, right? Here's the problem with that. If that was true, don't you think that they would have shown the public the documents by now? That's kind of a difficult one, right? So I think that it is extremely likely that Lisa Cook is indeed guilty of the charge that she did commit mortgage fraud. And they'll just chalk it up to an oversight or a mistake or something like that, right? So that's why I say that's probably not going to be very effective at predicting what's going to happen. I think that it likely is that she did commit mortgage fraud. So then the question is actually, but can Trump fire her over it? Because one, he can fire somebody for cause, but what is the standard for cause in this case? That's one part of it. And then the other part of it is that it was something that she did before she was in office. So can that be for cause? Now, I think the argument that the administration will make is that because she committed mortgage fraud, she cannot faithfully execute her role at the Federal Reserve with, that the public can't trust her essentially at that point, and that it affects her ability to do her job. So I think that is what they will argue. And then we'll see if the Supreme Court goes along with it or not. I don't know. So I'm a little bit torn on what the Supreme Court will actually rule. They've been pretty favorable to Trump, but they're going to want to preserve Federal Reserve independence too. But if they see that Lisa Cook did indeed commit mortgage fraud, I think that fact alone provides a lot of cover for them. So I think with maybe a 55% chance and a like 20% certainty level that the Federal Reserve will rule that Donald Trump can fire Lisa Cook. So that's what I think. That's my playbook. So when they rule on that, I think you want to be long treasuries. I sent you a DM. Why are you sending me that in DM? If you want to give a, so yeah, I think I will do it. It's just like, when am I going to find the time? Actually, you know what, Uzi? You might be able to get ChatGPT to automate it for you, because all you have to do is say, okay, on this URL, I want this piece of information. Actually, we can do a little bit of investigation here. If I can find the link, where did it go? Oh, we needed the most. We want the 2-year note, right? 2-year note, December, options, quotes. So the important thing is that we get the URL as in a really neat URL, which it looks like it is. We get futures, quotes, the actual instrument, and options, and we can predict the instrument name, so that's all good. And then we want this property right here, right? So we can come in here, inspect that specific element, come back here. Okay, it is selecting it. Oh, yeah, I need to get this a little bit smaller. Okay, so the containing div that it's in does not have a name, so that it's not particularly helpful. Oh. Oh, I need to make it a little bit. That is not what I wanted. There we go. That one's not named. That one is. Okay, so that makes it a little bit harder. But I think we can still get it. So basically you would say, I want write me a script in C# using only default libraries to pull that value from the web page. Yeah. You'd have to change the URL every expiry. No, I can write stuff to fix that. Because I can calculate when the expiry is, and I can calculate what the next one's going to be. And then just have it switch which one it's looking at on the correct day. Wait, convert the fraction to the decimal? You mean the percent to a decimal? So it would be 0.0162. Oh, and then you annualize it, so you times it by 16 or something like that? Or is there a different way that they annualize it? Oh, yeah. Square root of 250, which is basically 16, yeah. Gotcha. Oh, you know what I'm just realizing? Because I have an indicator that gives you the projected ranges based on based on a volatility index. But I went and I made another version of it that does the same thing based on average true range. And I don't think I ever put that one out. Because basically, I think that you can, so let's go look at that. Or wait, this might be a long time, right? I think that I would have put it in alpha, perhaps. Alpha or free, maybe? Maybe I didn't. Oh, there it is. Projected range. Yes, I do. I do have it. It might not be in the latest package. I'm not sure. Do you have a speculator Seth? Like come into indicators. Speculator Seth. Projected range. Do you have that one? That's funny. It has the index in there, even though it uses ATR. I have my own, and it has its moments, but it's not as good as using IV. Because the whole thing is that I would expect them to be close. I would expect them to be very close to each other, but not quite. And particularly in situations where the IV shows it higher than what the ATR does, would be situations where I would take note. Because that basically means that the options are expecting more volatility that day than usual because of news or something like that, right? So this might actually be a good question for ChatGPT. There are different methods to predict the range of the day in an instrument. In this case, 10-year futures. For instance, we could use the ATR. We could use the ATR and project based on standard deviations of ATR. We could also just use implied volatility. Okay, let's say we could also use is there any research on what methods would be the most effective? Is there something better than implied volatility? I think this would be a good case for using ChatGPT, because I should be able to get it to give me research, and I think that there's going to be research on that, and there's a lot of research on that, and ChatGPT is going to be really good at summarizing it. Short answer up front, there's no single clear winner across all settings. Implied volatility is very informative, but not universally the best. High quality realized measures, high frequency realized volatility, or daily high-low range often match or beat implied volatility for forecasting the day's range. The best practical approach is usually a hybrid/ensemble that combines implied volatility plus realized intraday measures plus a simple historical range indicator and conditions on events. Below, I summarize key research takeaways and then give practical recipe you can implement. Okay, what the literature says in short. Implied volatility is powerful. Classic work shows IV often subsumes past volatility and info and is a very informative predictor of future volatility, but it is not perfect and its edge varies by market and horizon. Yeah, I would expect, though, that in Treasury futures, that it would be pretty powerful. Because what we are discovering is that while I've used this kind of method in the past, the ways that I was doing it weren't quite kind of meh. But when you look at it with implied volatility instead of the volatility index, that in some cases it seems like it's almost to the tick. Okay. Realized volatility calculated from high frequency returns, 5-minute realized volatility, and the simple high-low range are excellent predictors of next day variability. Many studies find they perform as well as IV and sometimes better. That's interesting. And then it gives some studies. You had to do it with the move index too. Just because when we did it in trading view with the move index and I just charted it, and when I was looking at charting, I didn't seem like as big of a deal. So maybe I didn't look at hard enough. Maybe I didn't look hard enough. But this thing that it's talking about, realized volatility calculated from high frequency returns. So basically, well, it says realized volatility, but which I think they mean like how much, what was the high minus the low in that period, essentially, for the 5-minute periods. And then simple high-low range are excellent predictors of next day variability. But it lists some studies that we could look at here. let's see. Sometimes it hallucinates things, but usually doesn't hallucinate research like that. So yeah, they're giving me getting the most out of return data sampled at different frequencies. And this other one, forecasting stock index volatility comparing implied volatility in the intraday high-low price range. Cool. Okay. Combine them. Papers extending HAR or heterogeneous autoregressive models to include IV or the VIX routinely show improved forecasts versus single source models. Multi-source models, IV plus realized, RV plus range, are robust. Okay, and then it says futures interest rate markets nuance. Studies specifically on futures, including 10-year note futures, find similar conclusions. No single estimator dominates. Realized measures and IV both have value. And the optimal combo may differ from equity indexes. Why IV alone can be beaten or improved upon. IV prices jump with options, supply, demand, and risk premia. It reflects risk premium, liquidity, and hedging flows, as well as expected realized volatility. High frequency realized measures capture recently observed microstructure and intraday volatility clustering. And the daily high-low range captures intraday amplitude directly and is surprisingly efficient given how simple it is. So basically, basically you can look at the high and low of the day, and there's a certain point at which you can say, today is having more volatility than what the implied volatility was, I think. Oh, is that IV number that we're looking at a monthly one? I think so. Well, it's on the monthly futures, but it changes from day to day, right? Oh, I see what you're saying. You can use it on the ones. Yeah, that page that we were looking at least doesn't have that though, does it? Pull it back up here. Yeah, just monthly expirations. But you could get them from like your options platform or something like that. Hey, look, we're finally in the money. Practical recipe for predicting today's range on the 10-year futures. Data to compute implied volatility for short-dated options on the 10-year futures /note. Extract at the money IV and maybe a 25 delta put call skew. Oh, that's interesting. So they're saying, look at the skew between puts and calls, and maybe you say that the range on the upside is more or less than the range on the downside based on what people are putting in the options. Buyer's cost basis held nicely. Good observation. We should highlight that because it's actually almost uncanny how it just kind of held that line before pushing higher. My own trade was not as sophisticated, but we're not out of the woods yet, right? We've taken a lot more heat on it than we've gotten positive. But we are seeing a relatively decent meta order coming through now, and whereas earlier it was like, where's all the volume? Now we've had a good more than 10K change, so All right, anyways, data to compute implied volatility, realize volatility from recent intraday bars. 5-minute returns to daily RV using sum of squared returns. High-low range and historical average of range. I don't like this. Maybe I would compute daily RV using absolute value instead of square of returns, but I digress. Actually, in this case, probably square of returns, so the difference probably wouldn't be huge. So high-low range, ATR, and then macro event flags, and then the overnight return and intraday jump to measures. Baselines, regress next day realized range on yesterday's ATR, add IV, add realized R value, nonlinear ensemble optionally, and minus specification if you want to incorporate high frequency realized measures. Target variable choices, evaluation markets, RMSE and MAE on out of sample forecasts. What's that? Let's just ask it what that means. Coverage. Fractions of days where actual range is less than predicted range. Economic metrics. P&L of a strategy that sizes stops and targets using a forecast. That, I think, would be backtesting it. Use rolling walk forward, expanding window backtests, and check performance around macro events separately. No universal winner on average across many studies. IV is excellent, but realized high-low range often performs similarly, especially for one-day horizons. Combining them in an HAR plus IV or machine learning ensemble usually improves forecasts for 10-year futures. Specifically, expect IV to be informative, but less clean than equities if options are thin. Yeah. You're welcome for the rabbit hole, at least. Yeah, well, I've been down this rabbit hole before. It is giving me a little bit more interesting stuff, though. So it was saying, where's my get my pen out here. It's basically saying if we have the range here, and then how often is it like within that range, and how often does it like breach that range, right? But I think that it's also kind of, it's not even that. Like, I wouldn't even necessarily want to say, well, how often does it breach that range? But rather like, okay, when it does breach that range, how much of the day is above it after that, or something like that, right? Or I could just backtest and say, okay, if I take a mean reversion trade there and I hold it for an hour, what percent of the time do I win? Right? And then, but that kind of highlights the issue, because like if I do that, and then I said, okay, when I use this volatility measure versus this volatility measure, which one is better for the actual like trade setup? Well, the one that's going to win is whichever one predicts a higher range, essentially, right? So what I'm trying to sort out is what would actually be the metric that we should be comparing these against that would actually be useful for us, right? Because the measures that are out there are kind of based on what is useful for the people buying and selling options. But we're not buying and selling options. We're trying to make a specific trade at a specific time. Yeah, the shitty thing is the window for a potential trade is super small, and if a binary event causes the range to be busted, I don't have... Yeah, like the situations when I would expect the number to be relevant would be like during news events when you don't necessarily want to just have an order sitting out there, because what if it really outperforms the news event, right? And then in the situations where I think that it would be more useful, which is like a no news day where I'm expecting the range to be relatively constrained, and then it's like not even going to get to it, and I'll never have the opportunity. Yeah, I can totally see that. Okay, what is RMSE and MAE? MAE, the mean absolute error, the average of the absolute differences between your prediction and the actual value. Okay, yes, I'm familiar with that. RMSE, root mean squared error. Yeah. But I could see how we could come in and we could take ATR and implied volatility and the overnight range and what kind of a news event there is, and we can make up a formula to say, you know, which news events are more important, and have like a, you know, like this one is a 5 and this one is a 1 or something like that, right? And then pass it all into a machine learning model, like a random forest would maybe be like a good place to start. A random forest, and then have the optimization function on it be mean absolute error, and then crunch the data, and you would get a pretty good hybrid measure of daily volatility. But then how much would it help our trading? I don't know. At the very least, doing that would be a really good base. I mean, when I was getting into machine learning sorts of stuff, that was always kind of like, that should be the test case, doing it in NinjaTrader. But then I came to the point where it was like, yeah, but it's kind of hard to do that in my version of NinjaTrader, so maybe not. But maybe if we get to the point with my platform, right, where I'm getting data and things like that, and then I could show you how to write those, and it would be really, really easy in my platform. So maybe it's not worth taking it that far right now. Look at anything that keeps me from trading, randomly placing a trade in the dead center of a day's range to be useful. Yeah. Well, and that's where, like, for me, it comes back to, I think that the thing that's, like, there's all of these different things that we can prove about markets, right? What are the ones that are going to be the most useful to us specifically? And you can kind of take that two different ways. One could be, I have a certain amount of money, now give me all of the possibilities. Okay. The problem with that approach is that the ones that are most beneficial to you basically end up being like buy and hold an index, right? So, and there's no fun in that. So instead, we kind of have to admit that because we're trading futures, that means that we have different goals from the average investor. And I think that to really justify trading futures, part of that goal is we have to admit that we just want to be involved. We want to be on the front line, and we want to understand the markets as much as possible, right? But we're trading high frequency, essentially. Okay, so if we say we are trading on a short time frame, and we are trading with a very, very little capital, like we're only trading like one contract. Okay, now from that perspective, what is the things about the market that are going to be most relevant to us, that is going to be most likely to give us profitable trades, right? And that's where we get the whole framework that I've shared on this channel, which is what you have to do is you have to predict orders on that very, very short time frame. You have to say, if I get in now, is there in the next 30 to 45 minutes going to be an imbalance between buyers and sellers after me? And what information can effectively predict that, right? And there are some things that we know. For instance, if we got a economic report, and sometimes based on the economic report, you know that they're going to move much further than just what the initial reaction from the market was, right? There sometimes that we know that there is going to be end of month selling or end of quarter rebalancing or whatever the deal is, and that sometimes those can predict those kinds of imbalances, right? But then there are other things like where what we can look at the past action and we can kind of see some places where we were in a trend and now we start trading a lot of volume that likely kind of constrains volatility. And even though there might be a lot of orders, and even it's still a continued imbalance, the price doesn't necessarily go your way because of the hole, right? So that's another thing that we kind of know. Basically, we can look at the structure and what the structure tells us about the liquidity, and that can kind of also help us predict how far it's going to go. So we got to combine prediction of orders with the liquidity conditions, right? Those are the things that are going to help us out the most. And the difficulty that we have is how you quantify all of that stuff, right? How do you quantify all of that stuff? Some of them can be quantified. For instance, I think that what we're finding here is that implied volatility and other measures of volatility in the Treasury futures in particular is more predictive of future orders than we thought. Yeah. That when you get to certain points that there is like people getting out or profit taking or something like that. Over the last month and a half, I've been plotting these ranges. On average, forecast contains today's action. News skews that, but that's always going to be the case with everything you quantify. However, even with the news, the plots are still really solid. Yesterday's high in ZN was printed on the BLS revisions. Yeah. What we need. So that's why I was asking, like, on your spreadsheet, is your spreadsheet like each row is a day? Like each row is a day, and then you have a column for the implied volatility, and you enter that in, and then the other columns that are the different standard deviations that you go and you put on your chart. Because if we have a historical record, the spreadsheet is just a calculator. Wow. Okay. So just do this. Just make a new page in the worksheet and track the IV. On this day, the IV was this. What was the number that you used for the IV? Right? That's as far as we need to go. So that we have a historical record of that number. Because then what we do is we say, this was the range. This is what the actual, this is how much it went above it. So if let's say that if it didn't make it, that it'll just be a 0 or it'll be a negative number. Let's say it was a negative number. Okay. And then we can, so negative numbers so that you have the data, but then we can chop it. Say if it underperformed, then we get 0 and that's good. We were right on. But if it goes beyond it, then that's where the mean reversion trade wouldn't work and that was bad. So those ones are the ones that are bad, right? And then we would calculate the mean absolute error, or we would no, we wouldn't do that. We would just calculate for each day if it outperformed, by how much it outperformed, right? And then we would make a distribution histogram. And I would expect that if this is 0, that it would be something like this. And then maybe we could even figure out, you can make a graphing function to figure out what kind of a function this is. And based on that, that might inform some things that we might want to do. Here, wait, let's see. Maybe if I explain that to ChatGPT. Oh wait. What's so you call it a histogram, or you can what is the function? I have to pull up R here. Density. Let's see if ChatGPT can figure that out. You should expect a spike at 0. Most days don't exceed your prediction at all, which is what I said, plus a right-skewed, heavy-tailed continuous distribution for the positive excesses. In other words, a zero-flated / hurdle distribution with a positive skewed tail. Often well modeled by log normal / gamma for the body and generalized Pareto power law for the extreme tail. Below is a basic guide, what to expect and how to check it, and practical modeling choices. What the distribution looks like at the mass at 0. If actual range is less than predicted range, you record 0 excess that creates a point mass at 0. Positive support only excess equals max, so the continuous part lives on between 0 and infinity. A right skew / right fat tails. Most breaches are small, but occasional large misses happen. The body may look like a decaying exponential log normal gamma. The far tail is often heavier, sometimes roughly Pareto / power law, so extreme values are more likely than a Gaussian would predict. Yes. Heteroscedasticity and clustering. Big excesses cluster around events, so the unconditional distribution mixes different volatility regimes and gets heavier tails. Models that match that shape. A two-part hurdle model. Model P equals P, probability that you get a trade with a logistics or probability or a classifier ML. Model positive, blah, 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 blah. A lot of this is stuff I don't understand now. Log normal, heard that before. Gamma Weibel, flexible for skewed exponential models. Wow, it's like going way further than I thought it would. Okay, but the question is, okay, are there potential short-term trading implications? How do I word this? Which one of those models best describes it? Does that suggest a short-term trading strategy? What the distribution tells you. Mass is 0. Most days don't exceed forecast. Once the forecasted range is touched, the most likely outcome is that the market doesn't go much further. That trade favors a fade/mean reversion trades right at the predicted edge if you can control for the occasional breakout risk. In other words, you have a stop. Right skewed positive tail. A small fraction of days blow right through the predicted range. These are your breakout days. The heavy tail means these breakouts are much larger than average and drive a lot of variance. So 70-80% of the time the range is respected. 15 to 25% of the time modest breach. 5% of the time large breakout. Yes. So the trading implications. Fade strategy. Sell. Works if you can tolerate being wrong on tail days. Your stop has to be wider than the typical modest breach, otherwise you get whipsawed. Position sizing needs to be small enough to survive the rare tail events. Breakout strategy. Wait until range is exceeded, then ride the tail, but you will chop around often because the bulk of breaches are small and reverse. You only make money if you filter out the chop and catch the fat tails. Hybrid/conditional strategy. This is what many systematic traders end up with. Fade the forecasted range unless there's a high volatility event, momentum confirmation or flow imbalance, and then flip to breakout mode, or fade initially if exceeded by more than a threshold, then flip to a breakout. The location of the median axis tells you the minimum stop distance you need if you're fading. Tail index tells you how often your stop will get blown out and by how much. Zero probability directly gives an expected hit rate if you fade blindly. Conditional expectation tells you if chasing breakouts has positive expectancy. I think this is worth putting some more research into. I'm not sure if I can justify it like right now. My guess is that when you go and you do it all, that it's kind of suggests that like because of the fat tail distribution of it, like sometimes, you know, it's gonna work most of the time, but you're gonna take a big loss, and that like ultimately it's not that huge of an advantage. But then you could argue that I can predict the times when it is that 5% where it just runs, right? that I can use other information to predict that, right? I'm not too sure though if all of that would actually give you a better hit rate or whatever you would call it compared to you just doing it intuitively, right? In other words, you're putting a ton of effort into automating it, or not automating it, but like quantifying it. And then you got that one piece. And is that one piece so valuable that that's worth doing that on its own? And I'm going to say probably not, because like there's already a lot of research on this subject, right? But if I was a firm and I could combine that with all of the other things that I know can predict future orders,
order canceled,
then it would be really useful, part of a larger framework. But you can also, I think, figure that all out intuitively and do just about as well. So Seth could potentially automate it, but I don't think that it justifies that it's so powerful that it justifies spending a lot of time on it, like right this minute, you know? Okay, stop everything we're doing on the stream. We're going to write that and then, right? Because that's kind of what I'm thinking about. The 5-year, by the way, is turned down a little bit more than the others off of the highs. So the change in cumulative delta doesn't seem too significant to me. So I think I'm just going to sit tight. I'm just going to try and hold this until I've got to get going. I think I did address this, but Uzi was saying that the loss you take is within your control. Yeah, so you can come in and you can say, here's your distribution, and there's going to be a big spike at 0, and then the rest of it is going to be like this. But you can say, I'm going to cut it off right here. And based on what the density function looks like, will inform where we should put that stop, potentially, right? So that you make money most of the time, and then you don't experience the biggest tails. Would be the way that you'd do it. But the problem is going to be where you put that number is going to get hit frequently enough that just on its own, it's probably not super amazing. But if so basically, like, it's a good framework to work through, where if you can, with the rest of your intuition of the market, know when it's not going to be one of those fat tails, right? Which is to say, when you come in and you say, I think that it's going to mean revert, and then it doesn't, those are the days that matter. And if you're not getting that one right most of the time, then it's not going to help you, right? Well, is there good news? Bad news PPI data. Well, the PPI was negative, so I think overall that's a good thing for the financial markets and for treasuries in particular. But it's a good thing that it's like, okay, that means the Federal Reserve is going to cut rates and things are going to get better. But it's bad news in that, like, things are pretty bad right now. So if you're a Zero Hedge subscriber, there was an article yesterday. Is it still the one that's pinned? By the way, I figured out why I couldn't reach Zero Hedge. It's because I wasn't putting www in front of it. Put www in front of it, and then it routes it correctly. Yeah, it is still pinned. Oh, no, it's not pinned. They took it off. But basically, it was saying that some of the analysts, particularly one from Bloomberg, were going back through all of their own modeling and everything based on the updated number from yesterday's revision. Because remember that revision is basically from like April 2024 until April of this year or something like that. So most of that time period is under Biden. And there's still some data from then until now that we're not going to get until next year, essentially, right? So, but if they just like adjusting that period and then extrapolating where we are to now with the data that we've had for now, but with that revision, they were basically saying that we entered into a recession in April 2024. That we've been in a recession this whole time. And isn't that kind of what we've been saying for the past year? Told you the recession was real. So this whole time I've been saying it feels like a recession, but the data doesn't say that we're in a recession. Well, the data doesn't yet say that we're in a recession. Now it looks like maybe the data is telling us that we are. Is it that Powell is worthless? Well, I think that in this instance, the real problem is our data methodology. And where I would say Powell is worthless is that the one thing that anybody in a position of power, whether you are the head of the BLS, the president of the United States, or the Treasury Secretary, or the president of the Federal Reserve, the one thing that any of those people could have done in the last 2 years that would have helped us would have been to push for better quality data. And they didn't. So I can't necessarily sit down and say, well, you're really, really bad at your job, mister, because you didn't do that. Because that's something that I would only expect somebody really, really like a generational talent to realize and figure out, right? But he wasn't the guy that we needed, apparently. Because we needed somebody that was either going to say there's a problem with the way we collect data and we're going to change that data, or somebody that had the balls enough to say, well, these are where the errors are and we know that things are bad, so we're going to cut. Because really, the other thing that they were saying was that they should have been continued cutting in February. That basically, like, we went into recession. They probably should have cut earlier in that summer. They didn't do it until just before the election, because then it started to look like, oh, well, this is going to hurt Democrats. And then when Donald Trump won, they said, well, we're going to wait and see how this 50 basis point cut goes, and then we'll reassess. And they should have done another cut in February, and they didn't. They've pushed it back, and now they're doing the cut. So whereas before with all of the information that I had, I was saying the economy is much worse than it appears and we need a rate cut. And I was saying rate cut like May, June, July at the latest, right? So we're like 3 or 4 months late from when I think that we should have had a rate cut. But now this new information shows that even that was wrong and that I was too late and that it should have been in February. But I do remember saying, they should cut in February. I remember at the end of last year saying, like, they should probably cut in February, and then they didn't, right? So, it's kind of one of those situations, I think, always with the market. You can be completely right, and yet it not actually help you, But I definitely feel vindicated. I tell you what, man. The the political clouding of this issue is so real. Oh my gosh, it is so real. Because even after that huge payrolls revision yesterday, where they revised the number of jobs created by like 1 million jobs, which by the way, before we were saying that there's like 2 million people out of work. Okay, so like that's pretty significant error, right? So it's basically there's 50% more people out of work than we thought, right? Despite all of that, I saw so many posts on Reddit and whatnot trying to argue that the Federal Reserve isn't going to cut rates next week. Like on the r/stock market subreddit, there was a post that was like, this guy, here's his explanation, explain to me why I'm wrong, sort of a thing, right? And in all of the economics threads, there was still people arguing about what we shouldn't be cutting rates. There was a thread, or there was a story earlier in the week from the Financial Times where somebody said the Federal Reserve should not be cutting interest rates right now. And I said, you know what? Let's wait until after, Tuesday before we decide that one, right? Okay. And I was correct. It ended up being that data came out and it was really dovish and kind of destroyed that guy's argument. But even after that, people are still posting the story and arguing about it, even with the new data. And it is so absolutely stunning to me. Nobody pays attention to interest rates. Nobody pays attention to inflation on all of these numbers, except for when everybody's paying attention to it. And then all of a sudden, everybody thinks that they're an expert and they know everything about this thing, and that the people that are watching this every day know nothing. And they come in and they say the absolute batshit craziest stuff that proves that they have absolutely no clue what they're talking about. Because there is basically like a 99% chance that the Federal Reserve is going to cut interest rates next week. And at this point, I think it's not a question between whether they cut or not, but between whether it's a 25 basis point cut or a 50 basis point cut. Although it is looking like the market has not moved as much as I thought it would on PPI. We'll see what it does tomorrow after CPI. But if it is similar to this, then that means that it's going to be a 25 basis point cut, right? So now on one hand, it is a little disappointing to me. I want to teach people about this stuff. I want them to know what's going on with the economy, and I want them to understand the bigger implications, the complexity of economics, and why we get things wrong like this, and why the Federal Reserve got this wrong in this particular case, so that we can fix it and we can make society better. And it's a little frustrating to me that it feels like that the world isn't listening, that everybody has their own explanation for things that's based more on politics than it is an understanding of the science of it and how to fix it, right? But on the other hand, that means there's lots of edge available for us because most people just have no clue what is going on. And even a lot of people in the trading world are just saying stupid stuff. What will the market reaction be? Well, I feel like it's a little bit too early to be talking about FOMC day, but we got 5 minutes. Let's talk. Let's try and predict what we'll get. So the first thing is that there will be a change in the statement, and the verbiage of the change in the statement could be significant. For instance, I would expect them. Before all of this, I would have expected them to say that, it's time for us to normalize policy, and they wouldn't change the statement too much, right? But now I think that the statement is going to have to make some nod to that the labor market is weakening. They were concerned about a recession, things like that, right? So depending on how dovish the verbiage is in there, that could potentially be an impact, right? But As has been the case in the last couple of meetings, I think the thing that matters more is what Powell himself says. And I am concerned that what you get is going to be similar to what we've had in the past, which is he's going to cut, but he's still going to talk hawkishly. And here this gets back to this thing that is like, I'm starting to have a hard time explaining everything that Powell has done. Like, not every decision that the Federal Reserve has made is a perfect reflection of Powell himself. But when I look at what he says in those press conferences, I have a hard time squaring some of it away. Why is it that he was so dovish September a year ago, just before the election, when everybody was saying the Federal Reserve shouldn't do anything because of the election? And then for the last 6 months, where things have been getting really, really bad, a lot of people are struggling. I tell you what, the job market is just absolute hell right now. It's worse than 2008. It's harder to get a job than it was in 2008. It's just absolute nightmare. And everything's fine. And even by the data and the own pieces of information that he says he looks at, I can't explain it. And I think it's starting to get to the point where I think that the only reasonable explanation is that Jerome Powell just hates Donald Trump and that he does not realize that it is affecting his judgment. That's the only theory that makes sense to me anymore. Yeah, like Apal said, he's going to cut, but he's not going to do it happily. Maybe I'm wrong. And he comes out and he says, actually, we were so wrong about everything. And yes, we're going to cut now. And we're going back to, we expect to continue cutting regularly until we get back to a neutral rate, which is probably 200 basis points lower. That's what I would love to hear. Because that's what I think. That's what I would be saying. Is monetary policy is too tight. We're going to continue cutting rates until we're back to a neutral interest rate. And we will be doing it at a steady pace. And that we think that the neutral rate is at 2%. 200 basis points lower. Right? That's what I would like to see. It's funny that Trump was right. Oh, yeah, he was totally right. I mean, I don't think that Trump was right because he understood what was going on. That's what's funny to me. Right. He just knows that interest rates are too high and and things aren't growing as fast as he would like. And I don't think that he really cares what the inflation is going to be. Well, we did not get too much from this. I'm just going to scratch it because it's time for me to get going. On the other hand, I think the Cent is really smart. It really bothers me when he makes comments and some of the, many of the comments that he's been making are spot on. Like, we are really trying to transform the economy, and the high interest rates are a huge impediment to that. And the rates need to be lower to support the labor market anyways. So it's really frustrating to see them, getting really excited about things like inflation, for instance, when the reality is that because the inflation that we're seeing now is mostly cost push, interest rates aren't going to do anything about that. So, country sees this decision against, I don't know, we'll see. If the economy actually goes into a recession, economists will forever and after argue about whether it was Donald Trump's tariffs that pushed us into a recession or if we were set to go into a recession anyways because of the high interest rates. I can only say that the new data says that things were much worse during Biden's term than anybody realized. Than almost anybody in the professional world acknowledged. And I always said that it was bad. I'd say that it is even worse than I thought. I feel a little vindicated. I feel a little vindicated. I should probably go on TikTok and try and argue with some of the guys. Like, I really like Matt Clark, and we've had some back and forth. But I kind of, this whole time I've been saying, like, the economy is weaker than people expect. They need to be cutting interest rates. The data is bad. There's problems with this data. There was a little bit more back and forth when we replaced the BLS secretary, or I forget what they call it now, anyways. But BLS guy and with Cook and everything. But now I'm kind of sitting here going like, okay, look, I said that there was a problem with the way the professional world was looking at this. Do you believe me now? No. But as people tend to do, we ignore. We just kind of conveniently forget. Okay, well, by the way, how did the robot do today? It made $53. Hey, that's not bad. I tell you what when the robot works, it's great. But by the way, I would also say that the entry signals tend to be okay, but we need a better exit strategy. But anyways, I gotta get going, guys. I will see you tomorrow. We got CPI. CPI tends to be the bigger one. We'll see. I think that after CPI is out of the way, we should see some big flow sales. So see you guys then. In the meantime, stay excellent.